Washington, AFP, the sweeping tax cuts adopted on Wednesday, December 20, by U.S. lawmakers while reducing rates on corporations, also aim to encourage multinational businesses to repatriate huge earnings amassed abroad. U.S. corporations, notably in the tech and pharmaceutical sectors, have for years accumulated profits offshore to avoid the comparatively high U.S. tax rates of 35%, although most companies in Indiana reality pay much less. The stockpile of cash now stands at about $2.5 trillion US dollars, $336 trillion, according to the Congressional Joint Committee on Taxation. In 2016, for example, Apple stashed more than $200 billion US dollars abroad, while Microsoft parked $100 billion US dollars, and Cisco, Oracle, and General Electric all followed suit. Some firms resorted to so-called corporate inversions, reverse mergers allowing them to be incorporated in low-tax countries, avoiding the U.S. tax system altogether. Last year, several inversion efforts, including the merger attempt by drug companies Pfizer and Allergan, drew the ire of American officials. By dropping the top corporate rate to 21% from 35% and taxing only profits earned U.S. territory, the reform represents an effort to make the United States more enticing to major corporations. Money frozen overseas and in parts of the world, and some of them don't even like us, President Donald Trump said on Wednesday in remarks celebrating the tax bill's passage. And they had the money. Now they won't have the money long. To help encourage earnings repatriation, the tax package includes a one-time, across-the-board tax break for companies that bring the cash back. Businesses will have to make a one-time payment of 8% or 15.5% on repatriated foreign profits, depending on whether the assets are cash or investments. This could bring $220 billion US dollars to the Treasury, according to the Joint Committee on Taxation. But Eric Totter, co-director of the Tax Policy Center, this particular policy measure would reward overseas investment. We are taxing them less on their foreign profits than on their U.S. profits if they invest in low-tax countries, he told AFP. After the tax bill is enacted, foreign profits will be taxed at a minimum of 10.5%, including amounts collected by local authorities, a level well below the 21% U.S. rate. Totter said congressional scorekeepers were assuming the lower taxes would result in higher revenues, given the larger volume of repatriated profits. But this still encourages companies to invest abroad, he said. They have an incentive to report and invest income in low-tax countries. Industrial companies, such as makers of semiconductors, an industry prone to offshoring like many that trade in intellectual property, welcome the new rules. We would have preferred lower repatriation rates, but overall it's a strong bill for the semiconductor industry, Joe Passetti, a senior lobbyist at the Semiconductor Industry Association, told AFP. The tax plan also aims to encourage companies to be active again on U.S. soil, in particular those in IP-reliant industries, he explains. U.S. revenues derived from foreign sales of patented products will be processed for tax purposes as if they were earned by foreign subsidiaries, at a rate of 10.5% rather than the new corporate rate of 21%.